Today, in this video, I'm analyzing companies which are into tire manufacturing. The companies that I'm analyzing are MRF, Apollo Tyres, CEAT, JK Tyres, and Balkrishna Industries. The results for each of them have been updated. For MRF, the results are updated till March 19. For Apollo, it's June 19. CEAT, it's June 19. JK Tyres also up till June 19, and Balkrishna Industries up till March 2019. But all of these results or ratios are up to date till March 2019. From here on, I'll be continuing my analysis using graphs. All data have been plotted on the graph. The highest priced stock is MRF at 53,000 rupees per share, and the lowest price is JK Tyres at 71 rupees. Next, we'll look at how these stocks have done from where it was 1 year back. Most of these companies have fallen from 1 year back price by almost more than 35%. The lowest fall was seen for MRF at 34% from 52 weeks back. The highest fall was seen in Balkrishna Industries at 52% from where it was 52 weeks back or 1 year back. And the other three companies, Apollo, CEAT and JK, have fallen somewhere around slightly above 40% each. The fall in price creates an opportunity for us to buy into the scrip, provided the ratios are all intact. That is, fundamentally, the ratios as per our requirement or as per our benchmark. Next, let us look at the earnings yield. This is the earnings per share divided by the price, which generally indicates what is the profit that the company is earning on per share basis. Here we want the earnings yield to be as high as possible. The highest earnings yield was seen for JK Tyres at 10.1%. That is, on a price of 71 rupees, the company's profit per share was 7 rupee 20 paise. That works out to an yield of 10.1%. And the lowest earnings yield was seen for MRF, where the price was 53,000 and the per share earning or profit behind every share was 2,587 rupees, which worked out to an yield of 4.8%. The other company like CEAT had an earnings yield of 7.6%, Apollo had an earning yield of 6.3%, and Balkrishna had an earning yield of 5.8%. As I mentioned earlier, higher the yield, the better it is. Next, we'll look at the price to earnings ratio, which is the exact opposite of the earlier ratio that we saw, which is the earnings yield. Here we divide the price by EPS, that is the earnings per share. So we get the price to earnings ratio. This ratio helps us understand where the price is compared to the company's earnings of the latest year. Here we want the price to earnings ratio to be less than 25 times. That is, what is the price that investors are paying for the earnings of the company. So we don't want to pay more than 25 times the earnings that the company has shown for the latest year. MRF's price to earnings was the highest at 23 times. That is, the price was 53,000 rupees and the earnings was 2,587, which is 23 times more than the company's earnings. The lowest price earning multiple was seen for JK Tyres at 8.8 times. On a price of 71 rupees, the company's earnings were 7 rupees 20 paise. That is, for a 7 rupee 20 paise stock or for a 7 rupee 20 paise earnings per share, investors were willing to pay 71 rupees. That is 8.8 times more. So the least multiple that the investors are willing to pay is for JK Tyres. This creates an opportunity provided other ratios are intact, fundamentally strong, that is. The second highest price to earnings ratio was for Balkrishna, where for an earning of 40.50 paise, investors were willing to pay 702 rupees per share. Apollo Tyres price earning multiple was 12.4 times and CEAT's multiple was 11.6 times. So here we are looking for a multiple which is below 25 times and as low as possible, so that we are not paying a very high price against the earnings of the company. Next, let us check the current price earning multiple that we paid against the 5 years price earning data and also compare it against the 3 years price earning value. So then what we are doing is we are comparing the current price earning against its historical averages of the last 5 years and last 3 years. All these data is sourced from screener.in. MRF's current price earning multiple was 23.6 times, as we saw earlier. That is, investors were willing to pay 23 times more price against what the company showed as earnings in the latest year. Against that, the 5 years average was 16.8 times and 3 years average was 19.6 times. So the current price earning multiple is definitely above its 5 years average as well as 3 years average, which is basically, it can be looked in both the ways. It can show that investors have a lot of confidence in this company. Alternatively, investors are paying a very high multiple, or when we want to buy into this company, we'll have to pay 23 times more against the earnings. For me, I would want the price earning multiple to be below 25 times, which it is, and also below its averages, so that I'm not buying at a heavy premium or a high premium. Apollo Tyres' current price earning was 12.4 times and it was below its 3 years average and slightly above its 5 years average. So the current price earning multiple is very near to its 5 years average. CEAT's current price earning was 11.6 times and it is below both 5 and 3 years average price earning. So which is a good opportunity to look into the other ratios and understand whether we can buy this script based on price earning. Although we will be also looking at other ratios of price compared with different variables like book value, sales, and so on. JK Tyres current price earning, as we saw earlier, was the lowest at 8.8 times and way below its 5 years average of 15.2 times and 3 years price earning of 20.2 times. So this is almost fallen 50% below its 5 and 3 years average. Balkrishna's current price earning was 18.4 times, second highest, and very near to its 5 years average price earning and below its 3 years price earning. So this kind of analysis helps us understand where the current price earning is and compared with its 5 and 3 years average. Here we want to buy as low as possible, as I mentioned earlier. Next, let us look at the current market price and compare it with the operating cash flow first and then compare it with the free cash flow. I'll explain each term. Operating cash flow is basically all cash income and expenditure that the company can account for through the operating activity of the business. So here, unlike profit, here we are only looking at cash inflows and outflows from the operations of the business. So there are three types of activities. One is operations, one is investment, and the third is financing. So here we are looking only for cash coming in through the operating activities and per share, that is, and compare it against the current market price. Here too, like price to earnings ratio, we are looking for a as low possible a ratio and below 25 times at least. And most of these companies price to OCF is below 25 times. MRF's price to operating cash flow ratio was 16.3 times, meaning the investors were willing to pay 16.3 times more than what the company showed as cash earnings for every share. Apollo's price to cash ratio was 8.4 times. Balkrishna's price to cash was 16.7 times, and the lowest price to cash multiple was for JK Tyres at 2.2 times. This was the most reasonable price to cash flow ratio that we should look for. Even though earnings may be high, but if the price to cash is low, that creates a very good opportunity. Next, we'll look at the price compared with the free cash flow. The free cash flow is calculated by removing out all investments, that is cash investments done in buying of fixed assets, from the operating cash flow. Here too, we don't want the price to free cash flow to be more than 25 times. And if it's negative, then that is another problem that we need to look into, which would then mean if the ratio is negative like we have for the three companies, then that would indicate or signify that the company's investments in buying of fixed assets is more than what it has earned through the operations of the business. This I'll explain again later when we come to the 5-year profit and cash flow analysis. MRF's price to free cash flow is negative 38 times, meaning the company's free cash flows were not there for use in financing activity. All these I'll explain later in the 5 years analysis. Apollo Tyres price to free cash flow is negative 7.5, that is free cash flow was negative. CEAT was minus 6 times, negative 6 times, and JK Industries was a positive 3.2 times, meaning they still have some free cash flow left with them. Balkrishna's free cash flow was 146 times. So this ratio basically then would indicate to us how much we are paying against the free cash flow of the company. Here too, as I mentioned, it should be below 25 but above 0 and not negative at all. The negative part, as I explained again, that I'm explaining again, is that the company has invested more into buying of fixed assets than what it earned through the operating cash flow. Next, we'll compare where the price is compared to its book value. Book value is the actual value of the share as per the company's records, or as per what the company thinks its shares are actually worth. And this we are comparing against the market price of the share. That is what the investors think the share is, what the value of the share is. MRF's price to book ratio is 2.1 times, which signifies that the market price is 2.1 times higher than the company's actual share price. Here we want it to be below 2.5 times and as low as possible. So the lowest multiple, or the multiple between price and book value, was for JK Tyre at 0.8 times. That is, the current market price has gone below its book value. We are getting it at a discount. We are also getting Apollo Tyres at a discount to its book value. So this again creates an opportunity when the valuation metrics are at a very good level. We can look at other ratios like RoE, RoCE, ROI, and so on, which I'll explain later on, to get a complete picture of how the company is doing. Just because the valuation is low does not mean that we can buy those scripts. It just means that it is at a good valuation and we can think of buying, provided all other ratios are also at their proper level. Balkrishna's price to book ratio was 2.9 times, the highest in the group. and the most expensive compared to its book value. Next, we'll compare the price to the sales or the entire market cap against what the company did as sales. This helps us understand how much we are paying again, what is the multiple we are paying against the sale that the company has done in the latest year. MRF's price to sales was 1.4 times, which means that the entire market cap of the company was 1.4 times higher than the sales that the company did in the latest year, that is 2019. Here we want it to be as near to 1, which would signify that the market cap and the sales are of almost the same value. The other three companies, Apollo, CEAT and JK Tyres, all have their market cap below what it did in sales. That is, the sales were even higher than what the market has valued these companies at. So this creates a very good opportunity. The heaviest discount was seen in JK Tyre at 0.2 times. That is, the market cap was trading 20% of the sales, below sales, which creates a very good opportunity to buy into the scripts. Balkrishna was trading at a very high multiple of 2.6 times. That is, market cap was 2.6 times higher than its annual sales of 2019. As I mentioned, we want this to be as low as possible, near 1 times. That is, the price and the market cap and the sales are almost at the equal level. Next, we'll look at how the profits have grown over a period of 5 years versus how the profit has grown over the recent 3 years. This would indicate to us how the company is controlling its costs and expenses to grow its profits. MRF has been growing its profits at the rate of 3.7% over the last 5 years. That is, from 2014 to 2019, the profit has been growing at 3.7% on average. These are the compounded average growth rates. But in the recent 3 years, from the recent 3 years, the profit has fallen at the rate of 26.6%. So there is definitely something wrong in the recent 3 years, because in 2019 the profit has fallen by 26% where it was 3 years back. Apollo Tyres has seen a fall in its profit from both 5 and 3 years. The recent profit has fallen below where it was 5 years back and where it was 3 years back. So this is negative for Apollo Tyres in terms of profit. CEAT has managed a mild growth of 0.5% in a period of 5 years, but in the recent 3 years the profit has seen a fall of 14.2% over a period of 3 years. JK Tyres has seen a fall in its profit over a period of 5 years at the rate of 7.7%, whereas in the recent 3 years the profit has fallen faster at 25.1%. So this is why, maybe because of this fall in profits from both 3 years and 5 years back, we are getting it at a low multiple in terms of price earning, price book, price sales. All these three companies we saw earlier were trading at a discount to its sales. That is, the market cap was even below its sales for all the three companies, Apollo, CEAT and JK Tyres. Balkrishna's was the only company whose sales has been increasing, the profit has been increasing over the period of 5 years at the rate of 8.6%, whereas in the recent 3 years the profit has further increased to 20.6%, which none of these companies managed to do. All of these companies' recent 3 years profit growth rate in profit has fallen by, highest was seen for MRF at 26.6%, followed by JK Tyres at 25.1%. So only Balkrishna Industries has bucked the trend by growing its profit over the last 3 years at the rate of 20.6%, which also then suggests why it is getting a high price earning multiple and price book multiple, as well as price to sales, which we saw earlier. Next, we'll compare the price earning that we paid for these companies and look at how that earnings are growing over a period of last 5 years. That is the PEG ratio of 5 years. MRF, we paid 23.6 times its earnings, and in the recent 5 years the earnings was growing at 3.7%, whereas in the recent 5 years the earnings was growing at 3.7%, and we paid 23 times for the earnings. Therefore we are getting a PG of 5.6. This 5.6 is calculated by dividing 23.6 by 3.7, not the percentage, just 23.6 by 3.7. So we get 5.6. Here what this signifies is that whatever multiple we are paying, are we also getting a good growth rate in that earnings? And if we are, then we'll be able to recover this multiple we paid much faster. So here I want the PEG. The blue indicates PEG, the orange indicates the profit growth rate of 5 years, and green indicates the price to earning multiple that we paid. So I want my PEG, which is in blue, to be below 1.5, which would then suggest that whatever multiple we are paying, we are also getting a good growth rate in profit. These are the historical growth rates of profit from last 5 years, and we are trying to project this over the future 5 years to understand how taking this particular trend of growth in profit and put it in the future 5 years and try to understand whether we'll be able to recover our capital and whether the profit will keep growing in that trend or not. So I want this to be below 1.5 times at least. Apollo Tyres, 5 recent price earning multiple we paid was 12.4 times, but we are not getting a growth in profit, which we saw earlier. There was a fall in profits by 4.5% from where it was 5 years back. So since 5 years the profit has been falling at the rate of 4.5%. So although we are paying 12.4 times, we are not getting the growth in earnings. So then how are we going to recover this 12.5 times multiple that we paid? So we want to see a change in this to positive, whether it is 1%, 2%, but we want to see it change to positive. Therefore we get a negative minus 3.5, a PG of minus 3.5, which is not good. CEAT, so and we paid 11.6% multiple in for the recent earnings, and we're getting a mild growth of 0.5, which I suggested earlier that we should at least get some kind of positive growth rate in profit over a period of 5 years. But the PG has shot up to 27.9 times. When we divide 11.6 by 0.5, we get 27.9. This then suggests that although this is good, but it will take us almost more than 11 years to around 11 years to recover our initial capital that we paid. If we calculate, if we take this itself as a projected growth rate over the next 5 years. For JK Tyres, the price earning multiple was the lowest as we saw. It was 8.8 times, but we are seeing a big fall in its profit of by minus 7.7% from where the profit was 5 years back. So that gives us a PG of minus 1.3, which is not good at all. When it is negative, when a PG is negative, we want it to be as high as possible. That suggests that the growth rate is low, and for example, although we are paying 8.8 times, we are seeing a fall in its profit by 7.7% since last 5 years. So here we will take a lot of number of years, more than 8.8 years, to recover our initial investment. So when we want to buy into a company, we want to see that we pay low price earning multiple, but we also get a good growth rate in profit. So what is the use of paying even 8.8 times the earnings if the earnings itself is not growing over the last 5 years? Balkrishna Industries, we are paying 18.4 times, but we are getting a growth rate of 18.6%, 8.6%. So that gives us a PEG of 2 times. So which is the best in the peer group analysis? So only MRF and Balkrishna have managed a good PEG of last 5 years. Next, we'll use the PEG of 3 years, that is, we'll compare the recent price earning multiple against the growth in profit over the recent 3 years. The recent 3 years is of more significance than the last 5 years because the recent trend in growth rate in profit of the recent 3 years would indicate what is the multiple that we are paying. For MRF, the price earning multiple we paid was 23.6 times, but the fall in profit was at a very high rate of 26.6%, just like JK Tyres at 25.1%. Although we are paying only 8.8 times the earnings has seen a fall of 25% over a period of last 3 years. Therefore, we get a negative PEG for all of these companies except Balkrishna, which saw a growth in its profit of the last 3 years at 20%. Therefore, its PEG is even below 1.5. It is at 0.8. We were paying 18.4 times and we are getting a growth rate in profit of 20%, which is very good. So it will not take us 18 years, but say 10 years or even less than that to recover our capital. So when we analyze these companies, we understand that all of these companies are in some kind of trouble, maybe because of sectoral downturn, automobile issue, or something like that. But all of these companies have seen a fall in their profits at different percentages, but all of them have seen a fall in their profits. Next, we'll try to understand how these companies have grown their sales over the last 5 years and over the period of last 3 years. MRF sale over a period of 5 years has grown at 5.5%, but in the recent 3 years it has seen a fall of 7.3% in its sales. There's a reduction in its sales by 7.3% compounded over a period of last 3 years. So this is not a good sign. All of the companies have managed a positive growth rate in sales for both 5 and 3 years. Here I want the growth in sales to be at least 10% and above year on year for both 5 and 3 years. Apollo Tyres 5 years growth rate in sales was 5.5%. That is, it was growing its sales from 2014 till 2019 at the rate of 5.5% compounded growth rate, and in the recent 3 years the sales has grown at 14%. Now we saw earlier, although the sales are growing, they are not having the capability or capacity to increase their profits. In fact, the profits have seen a fall. Even though sales are increasing, they are not able to sustain the profits. Even JK Tyre, as we saw earlier, had a fall in its profit for both 5 and 3 years, but sales were growing at 6.5% over a period of 5 years and 14.6% in the recent 3 years. So then we have to ask a question: if the sales are growing, why is the profit decreasing? Is it because their expenses are increasing, or what is the reason for the fall in, although they are not in loss, but there's a drop or reduction in the profit that they are earning from where the profits were 5 and 3 years back. CEAT also saw a good growth rate of 5 and 8.4% in its sales. Balkrishna saw a growth of 8% and 17% for both 5 and 3 years respectively. So these are good growth rates. In the recent 3 years, all these 4 companies have seen a growth rate of more than 10% except CEAT at 8.4%. Next, we'll compare the recent return on equity of 2019, that is, what was the profit that the company generated on the equity shareholders' money. Here, in the profit, we are taking the net profit, and in terms of equity, we are taking equity plus the reserve amounts. So here we have the total shareholder money or money invested by the shareholders, and we are comparing it against the net profit to understand what is the profit that the company has generated on shareholders' money. I want the ROE ratio for these companies to be above 15%. That is, the return that the company should generate it on shareholders' money should be 15% and above. Here, what I'm doing is I'm comparing the recent return on equity that the company has generated in orange with its 5 years average return on equity. MRF over a period of last 5 years on average has been generating an 18.5% return on equity, whereas the recent 2019 ROE was fallen to 9.5% below its 5 years average. Here also what I want to look at is that it should be in the recent ROE, it should be earning at least 15% and also above its average. Here not only has it fallen below 15%, but it has also fallen below its 5 years average. Although in 1 year there can be some kind of disruption in the return on equity, but if we want to look at a bigger picture, then we can look at 5 years average where it has sustained above 15%. So 1 or 2 years there could be some kind of problem, so we can ignore this because the 5 years average is very good at 18.5%. Apollo Tyres recent ROE is 8.4, below its 5 years average. Now here what has happened is its 5 years average ROE is also below 15 and its current ROE is also below 15. So both sides there is a problem. Not only the 5 years is below 15%, but the recent ROE is also below 15%. CEAT's average ROE for the last 5 years was 15.9%, which is good, but the current ROE is at 10.6%, which is below 15. So it is just like MRF in terms of return on equity. JK Tyres average ROE was 15.7 and its recent ROE is 9.4, below its 5 years average. Balkrishna Industries was the only company whose 5 years average and current return on equity was above 15%. So this is the only company which has been consistently giving out good numbers. Next, let us compare the profit that these companies have generated on the total capital employed. In this case, capital employed, I have considered fixed assets of the company plus the working capital changes. And this is the average of the fixed assets plus working capital. I have not considered in the capital employed the net worth plus borrowings, which is generally considered. Instead, we are taking fixed assets plus the working capital and we are using the average of the 2 years of 19 and 18, and we are comparing and we are trying to understand how much the profit, that is the not the net profit but the earnings before interest and tax, that is the operating profit that the company has earned against what it has employed into the business as fixed assets plus the working capital. Here we want it to be as high as possible, above 15% at least, for both the 5 years average return on capital employed as well as the recent RoCE value. MRF's 5 years average profit against the capital employed is 24.3% and the recent RoCE is 14%, which is slightly below 15. Apollo's has seen a below average RoCE of 14.6 and the recent RoCE has fallen even lower to 8.7%. CEAT's average is 19.2 and the recent RoCE is at 13.4. So the 5 years average is good. The recent RoCE is fallen short by around 2.6 or around 1.6%. JK Tyre has seen a below average RoCE in 5 years and even the recent RoCE is at 10.5%. so the values are low. Balkrishna Industries saw a good 5 years RoCE of 19.3%, and its recent RoCE has gone above its average. So when we are analyzing these companies, we want to see a value of what the Balkrishna industry has shown in the chart, that 5 years average is above 15 and the recent RoCE is above 15 plus above its 5 years average also, which shows kind of a strength in the company. Next, we'll look at return on assets. In this case, the assets that we are considering is the total asset of the company, and we remove out the current liabilities from that. So what happens is we get the entire assets that the company has employed into the business and what is the profit that it is generating on these total assets that it has employed. Now the reason for removing out the current liabilities is that these are the or we can say these are the liabilities on which we have to repay, and this is not what has been employed into the business by the owners or through borrowed funds, but from it has been received from the outside source, which cannot be considered for ROA calculation. So I've removed out current liabilities from the total assets to consider what is the return the company has generated, and the return is in this case net profit. Here we want the value to be as high as possible. The lowest ROA value was seen for JK Tyre, which then also, this is the 5 years average return on asset employed. So that is why this also suggests why it is trading at low valuations in terms of price earning, price book. It is trading at a discount to its book value also. So this is why we can see very clearly why the market participants or market has pulled the stock down to such levels. The highest ROA ratio was seen for MRF, CEAT and Balkrishna Industries of about 10%. Even Apollo Tyres has managed about 10% of return on assets. So we are using different kind of assets to understand the profitability that the companies have generated. So this gives us a fair idea as to how these companies stack against each other when we use different variables and compare that against the profit that these companies have generated. So in this case, what we are trying to understand is how much of the total assets the company has deployed into the business and what is the profit it is generating. So that shows efficiency of the business in a way also, because the companies would all have different assets base and the profit value would also be corresponding to what they have deployed into the business. Only JK Tyre has not managed to show a equitable profit against what it has employed into the business. So we want to invest in a company who is generating highest profit on the total assets employed into the business. Next, let us look at the asset turnover, which is the multiple of sales with the annual assets. Now in this case, the assets that we are considering is the net worth, that is the actual value of the company, that is equity, plus the borrowings. So we are clubbing up both sources of revenue, both sources of capital that the company has received from shareholders as well as from borrowings, and on that what is the sales that the company has shown. We can also use this to generate return on capital employed. This is another way to understand what is this is the capital. Net worth plus borrowing is the capital of the company, and we can compare it with the sales, or we can even compare it with the profit, net profit or EBIT. But in this particular case, I have compared the net worth plus borrowings, that is the total capital of the company, against the sales. So MRF's asset turnover was 1.3 times, which would mean that the sales were 1.3 times higher than the assets employed into the business. So this gives us a very good picture or idea as to how the company is doing in terms of generating sales on the capital that was employed into the business. So most of these companies have generated slightly more than what it has invested into the business in terms of capital. The highest return on asset or highest turnover of assets into sales was seen for CEAT at 1.6 times its capital employed. And the lowest multiple was seen for Balkrishna, where the sales were almost equal to the capital employed into the business. Here we want to see a ratio which is as high as possible. That is, companies are generating higher and higher sales against the capital employed into the business. Next, we will compare the last 5 years profit and see how much of that profit has actually got converted into cash. That is, how much cash has come in the hands of the company against what it showed or what the company showed as profit after tax value over the last 5 years period. MRF's last 5 years profit was 6,823 CR, whereas the cash coming in against that was 10,793. Here, this is not the total cash. Here, I'm considering cash from operations. I am not considering cash from investing activity and financing activity. This is only through operations. So here we want to see a value like this where the cash coming in through operations of the business is more than what it has shown as net profit over the last 5 years. Company's cash from operations was 58% more than what it showed as profit. Apollo Tyres cash coming in was 51% higher than its earnings, which is again a good sign. Most of these companies have a positive cash coming in and more cash coming in than what it was showing as earnings. This is a very important graph or very important metric or ratio to look at, which is the cash against the profit. This would indicate to us that whatever the company is showing as profit is actually getting converted into cash. That is, the companies are receiving cash against the profits that the companies have shown. The highest cash turnover was for JK Tyres, where it showed a profit of 1,376 and it received a cash of 3,177, which is 131% more than the profits. Balkrishna's profit also, cash also saw a jump of more than 50% against its profit after tax of last 5 years. So all of these companies have generated high cash against the profit after tax value. So this is a good indicator that most of these companies are generating good cash flows. Now let us understand, out of this cash flow, how much of the cash is still lying with the company. So then that would tell us that whether these companies are in a state of clearing of their borrowings if they have any, or pay dividend or do buyback using the free cash flow left with them. Now this free cash flow, as I mentioned earlier when we were doing the price to OCF and free cash flow comparison, the free cash flow is basically the value that we get after we remove the investments that we have done in buying of fixed assets from the cash that the company has generated through operations of the business. So basically what happens is we first look at the earnings or profit value and see how much of that profit has got converted into cash, and from that cash how much has been used in buying of fixed assets, and after deducting that value of that purchase of fixed assets we get the free cash flow, which can be then used in financing activity like doing buyback or bonus or doing acquisition and so on, like paying off or debt and everything. So this too is a very important ratio like the previous one, where we are trying to understand how much is the free cash flow and how much is being used in buying of fixed assets. So for MRF, the company has generated a cash of 10,793 CR, and it had a free cash flow of 2,401 CR left with them. That is 78% of the cash earned through operations has been used in buying of fixed assets, which is a high percentage, because I want it to not exceed 50%. That is, whatever cash the company has earned, not more than 50% should be utilized in buying of fixed assets. If there is a growth in the company, or there are big orders that the company has, and due to that if it is investing into buying of fixed assets, then it's okay. But otherwise it should not be investing a very high more than 50% of its cash earned through operations into buying of fixed assets. If they utilize 50% and 15% is left over as free cash flow, as I mentioned earlier, then that cash can be used into paying dividend and doing buybacks or issuing of bonus shares and so on. But if the company doesn't have any free cash flow, how will it pay all these things? How will it clear off its debt and so on? Apollo Tyres cash earning was 7,228 CR, but we see a negative free cash flow of 3,624, meaning that first of all it has invested entire cash earned through operations into buying of fixed assets. Over and above that, it has utilized additional 3,624 CR to buy more fixed assets. So it has invested more than what it has earned through operations. Now, when can this happen is when the company spends entire amount of cash from here, as well as does additional borrowings to fund this buying activity. So its cash to free cash flow ratio is minus 150%, which is not a good sign. Which basically, even if the company has a growth, we don't want to see such kind of investments into buying of fixed assets. CEAT saw a cash coming in of 3000 CR, against which it has spent an additional 177 CR into buying of fixed assets, which is just 6% more than. First of all, it has utilized the entire cash into buying of fixed assets over the period of 5 years. Over and above that, it has also utilized an additional 177 CR. So it has not only exceeded or spent entire of its cash, but it has spent an additional 177 CR. Again, not a good sign. JK Tyres has spent 72% of its cash into buying of fixed assets or buying of assets, or doing investing activity in fixed assets. Its free cash flow is just 875 CR. Only Balkrishna Industry has managed to keep its investments below 50%. So this is what I'm looking at. I want to see companies which are not spending very heavily in the last 5 years in buying of fixed assets. Balkrishna's cash coming in was 4,400 CR, against which it still had a cash of 2,585 CR, which is like 42% used in buying of fixed assets and balance left over as free cash flow. So only Balkrishna has managed to give us a good free cash flow ratio. Next, let us look at the recent years profit and compare that with the cash coming in through operations. Previously we saw the 5 years data. Now we are looking at the very recent 2019 profit conversion into cash. MRF's the recent profit was 961 CR and cash coming in was 1380 CR, which is a good 44% above its earnings, which is again good sign. And if we see, most of these companies have managed a positive cash earning against the profit after tax value. So Apollo Tyres earned 29% more cash than the earnings. CEAT has earned 94% more than the earnings. JK Tyres had a very high cash coming in of 300% more than its earnings. That is, it is generating high cash against the earnings. Balkrishna saw only 10% higher cash coming in than the profit after tax. Although this is also good, not bad at all. Next, we'll look at how the current year's profit of the recent 12 months has done against its last 5 years average profit. This would signify whether the company's current profits are above its 5 years average or below its 5 years average. Whenever the current year's profit is above its 5 years average, that shows a strength that the profits are growing. MRF's current year's profit is 961 CR, that is of 2019, and that is of the recent 12 months, and its average last 5 years profit was 1365. So this has fallen below its average by 30%. So there's some pressure in the profit of the recent 12 months. Same is the case for Apollo Tyres, seeing a fall of 24% below its 5 years average of 958 CR. CEAT saw a fall of 16% in profit when compared to its 5 years average. JK Tyres saw a fall of 28%. Only Balkrishna managed to grow its profit of the recent year above its 5 years average profit by 23%. Its 5 years average earnings was 599 CR and its recent profit was 739 CR, which is a 23% jump above its average. Now we slowly try to get to understand why this company is trading at a premium to all other companies. Next, we'll compare the recent year's profit against the previous year profit, that is 2019 compared with 2018, how the profits have increased. In 2018, the profit was 1090 for MRF, 90 CR, against the current year's profit of 961 CR, which is seen a fall of around 12% YOY. Apollo Tyres saw a growth from 2018 by 15%. CEAT saw a growth of 10% over its previous year. JK Tyres saw the highest growth in its profit from its previous year. Previous year it was 28 CR and the current year is 199 CR, which is like a 607% jump. But we should not be fooled by this high percentage value, because we generally don't see more than 10% or 20% growth in profits. Even if that is very good. Here what must have happened is, in 2018 the profit must have fallen quite considerably, and in 2019 that profit has got recovered back again. We'll need to look at the yearly 5 years, 6 years profit values to understand how the profit trend was. But when we look at just individual values, this looks highly inflated, so this needs to be investigated. Balkrishna saw a decent jump of 6% over its previous year. Here I want to see a YOY growth in profit of 10% and above that. Now let us analyze the quarterly YOY sales growth, that is from, as I mentioned, M stands for March. So the companies which have M written, that is from March to March comparison, that is March 19 to March 18 comparison. And the one where J is written, it is June 19 to June 18 comparison. So we're getting a 1 year quarter on quarter analysis. MRF saw a sales growth of 6% year on year, but the profit fell by 15% in the same period. Apollo Tyres saw a growth in its sales of 1%, but the profit fell by 44%, which is a very high drop from where it was 1 year back. CEAT saw a growth in both profit and sales of 4% and 5%. Sales grew by 4%, profit grew by 5%. So we want these kind of values, even if it's in moderation, it's still okay. JK Tyre saw a sales in its saw an 18% growth in its sales, but the profit fell by 76%, which is a very high drop from where it was 1 year back. Balkrishna saw a growth in its sales of 10%, but a fall in its profit by 5%. So Balkrishna's, up till now, all the ratios were good, except YOY analysis, the profit has slightly dipped by 5% against its previous year's March 18 quarter. So we want the sales and the profit to be growing. Even if it's at more than 5%, it's still okay, but the higher the better. Next, we'll look at how the sales and profit has grown sequentially from previous quarter. So when we are comparing from MRF, we are looking at December 18 with March 19. And when we will look at Apollo Tyres, we are looking at March 19 to June 19 quarter analysis. MRF's sales from its previous quarter has increased by 1%, and the profit has grown by 5%, so it's a good sign. So most of these companies in the June quarter have managed to grow both sales and profit from its previous quarter, where we saw a fall year on year for most of these companies. Apollo Tyres 1% sales growth, but 69% pickup in profit. So when we go back to the previous chart, we see a 44% drop in Apollo Tyres in profit. Therefore, the profit had already fallen. So in June quarter, the profit has gone up, and because of the low base, we are looking at a very high growth rate of 69%. So this should not fool us into believing that the company has grown at a phenomenal rate. CEAT has managed to grow 2% in sales and 22% in profit. GK Tyre sales fell by 1%, but the profit increased by 26%. So most of these companies are coming from low base. Balkrishna saw a growth of 12% and a profit growth rate of 28%. So sequentially in the June quarter, it seems the profits have grown at least from the lower base, and the sales have also managed to grow slightly for most of these companies. Next, we'll look at the net worth of the company, that is the actual value of the company, against the market cap, which indicates the valuation given by the market participants. In this case, net worth is the actual value of the company, where it is determined by selling all assets and paying all liabilities. So nothing is left as liability in the company, and then whatever is left over is the actual net worth of the company, which gets distributed to the shareholders. And then what we'll do is we'll look at the contingent liability, the liability which is not shown or not disclosed in the balance sheet, but disclosed separately under the notes section of the annual report. And this is an important liability to look at. We don't want a very high contingent liability. This is the liability which may or may not arise in the future, for which the company may have to pay just in case if it arises. So these liabilities are not shown in the balance sheet or not accounted for in the balance sheet. Therefore, we have to be careful that as a percentage of net worth, it is not very high. For me, I don't want the contingent liability to be more than 20% of the net worth. Only Balkrishna Industries contingent liability is slightly above my benchmark of 20% compared to its net worth. The highest net worth companies were MRF at 10,653 CR and Apollo Tyres at 10,040 CR. These are big companies, large cap companies, and Balkrishna is a 4,600 CR company, and CEAT and JK are somewhere around between 2,000 and 3,000 CR companies. And most of these companies have a low contingent liability compared to the net worth. In this chart, we'll be looking at three ratios together. We'll try to understand what is the multiple of debt against the equity, how high is the debt compared to the profit, and how high is the EBIT against the interest paid by the company. These three ratios are again very important to look at because they signify very important values which all investors need to understand. All these three ratios, debt to equity, debt to profit, and interest coverage, are connected with each other. When the borrowings is high against the equity, it will take more profits to pay off that borrowings. And if the borrowings are more than the profit, the EBIT that the company is earning, that will not be enough to pay the interest cost. So if the borrowings is very high against the equity, then that is the beginning of a problem. So let us see how the debt to equity and debt to profit and interest coverage ratios are for all of these companies. MRF's debt to equity was 0.2, that is, debt was just 20% of the shareholders' contribution. The profit was, or the profit would take around 1.7 years to pay off the debt, or we can also say that the borrowings was 1.7 times higher than the profit of this year. And since the debt portion or the borrowings is less, therefore its EBIT is 6.6 times higher than the interest it paid in the latest year. These values are of 2019. Apollo Tyres debt was 50% of the equity, and the borrowings were 7.3 times higher than this year's profit. Even though the debt was 0.5, the EBIT was 5.7 times higher than the interest paid by the company in 2019. So these ratios are good, although the borrowings is high compared to the profit. CEAT's debt was also 0.5 times its equity, and its borrowings were 5.9 times higher than the profit of this year, and its coverage, interest coverage, was 5.6 times its EBIT. JK Tyres debt was very high compared to the equity. The debt was 2.5 times higher than the equity. That is why we see that the ratios or the valuation was very, very low. That is the price to earnings, price to sales, and everything was, we are getting it at a discount. The reason for that is the company's debt portion is very high. The company has borrowed 2.5 times higher than the shareholders' contribution, or 2.5 times higher than the equity, which would then suggest that the company's profit will take 32 years. Using this year's profit, the company will take 32 years to pay off that borrowings or that debt, and therefore its EBIT is only 1.6 times higher than what it paid as interest cost in 2019. So JK Tyre cannot be invested in because its debt portion is very high, its coverage is very low, and its borrowings against the profit is very, very high. Balkrishna Industries debt portion was just 20% of the equity, or debt to equity was 0.2. Its borrowings can be paid off using this year's profit in 1 year, 1 month approximately. That is 1.1 times. That is, borrowings were 1.1 times higher than the profit. And since the borrowing was very low at 0.2 times, it had a very high coverage of, that is, the earnings before interest and tax was 100 times higher than the profit. So when we compare the interest paid, so if the company is paid an interest of 1, then its EBIT is 100. This is the ratio that signifies that. So here, in terms of debt to equity, I don't want the debt to equity to go above 1 times. I don't want the borrowings to be at a very high multiple of profits, and the interest coverage should be more than 4 times. That is, the earnings before interest and tax should be at least 4 times higher than what it paid as interest. So these ratios are very important to look at. Next, we'll look at the promoter holding of these companies. What is the promoters holding in this company, and what are the pledged shares, if any, of these promoters? in terms of promoter holding, I want the ratio or the percentage to be more than 30-40%. The higher the better, because that would signify that the promoters have high stake in the company and they would do the best thing to keep running the business in a profitable manner, because they are the ultimate beneficiaries of that. In terms of pledged shares, these are the promoters holding which have been pledged with banks. I don't want the pledged share to exceed 20% of the promoter holdings. When the promoters pledge a high percent of their holdings, that is a sign of worry, because if they don't remove that pledge, then the banks or institutions with which they have pledged these shares, these banks would dump these shares in the market, which would drop the price at a very fast pace. Apollo Tyres pledge shares were 15% and JK Tyres pledge was 35%, the highest in the group. See, this is why JK Tyres is being available at a very high discount. First of all, the debt was very high. Even the promoter's pledge is more than 20%. Although the promoter's holding is 56%, out of that 56%, 35% has already been pledged. So we don't want to invest in a company which has a high pledge shares. Apollo Tyres pledge was 15%, so it's nearing its 20% target. So we have to be careful when, if you are planning to invest in Apollo Tyres, that it should not exceed 20%. That is my benchmark. MRF's promoters were holding the lowest in terms of shareholding, 28%. So, and 0% was pledged. None of these companies have pledged except Apollo Tyres and JK Tyres. Next, we'll look at the debtors percentage of the sales. That is, how much payment was still left to be collected from the debtors against this year's sales. Then we'll look at how fast the company is collecting payment from the debtors in the recent year, and what was the collection days 3 years back. When we look at debtors to sales, I don't want the percentage to exceed 30, which basically suggests that the company has enough cash flowing in continuously to keep growing. When the debtors increase more than 30%, it means there is inefficiency in the collection from debtors. MRF's debtors were 14.9% of the sales, which indicates that the company is collecting payment from debtors at a very quick pace. Most of these companies' debtors to sales ratio percentage was below 20%, which is a good sign. And all of these companies are collecting payment from customers within 90 days, which is my benchmark. That is, payment from customers should be collected within 3 months or 90 days. The fastest collection period was seen for Apollo Tyres at 24 and 33 days. Here again, if you notice, JK Tyres collection period is very high at 68 and 74%, and its debtors are also very high at 18.8%. There's definitely some problem going on in JK Tyres, because of which not only is the company payment to be collected from debtors is high, its collection periods are also the highest in the group. And its debt, as we saw in the earlier graph, the debt was two times its equity, no coverage, high promoter holding, but high pledge as well. So all these things are affecting this particular company, JK Tyres. Inventory turnover, and we'll compare this turnover with its 3 years back turnover. Inventory turnover basically signifies how much of the inventory holding that the company had, against that what was the sales that the company did. So this signifies efficiency in turning over inventory into sales. MRF's inventory in the recent year was turned over into sales by 6 times. That is, sales were 6.2 times higher than the inventory holding of the company. Same was the case 3 years back also. So the companies, as a uh, comparison with 3 years back, the ratio is almost the same. Apollo Tyres turnover is also 5.5 and 5.8 3 years back, and 5.5 in the recent year. So it's turning over its inventory at a good pace into sales. The highest turnover was seen for Balkrishna. Its inventory holding was turned over 8 times into sales. JK Tyres inventory holding was turned over around 7 times in 1 year, and even 3 years back the turnover was around similar period. So all these companies have a consistent turnover of inventory into sales. There's no fixed benchmark as to how much these companies should turn around. It depends upon the sector that the company is in. Next, let us look at the average operating profit margin of the last 5 years on average and compare that with the latest net profit margin and net profit margin of the preceding year. The company has been earning 17.4% as OPM or operating profit margin since last 5 years. So the operating profit margin has to be more than 15% for all of these companies. That's my benchmark. And the NPM should be above 10%. So when we look at these group companies, only MRF and Balkrishna have managed an operating profit margin of more than 15%. JK Tyre had a 12.2% of operating profit margin. CEAT had a OPM of 11.3%, and Apollo had a 13.6% OPM in the last 5 years, so which is below my benchmark. In terms of net profit margin in the latest year of 2019, all of these companies had a very low net profit margin. Of that, the lowest net profit margin was for JK Tyres at just 1.7%, a very low NPM. This again could be because of the previous chart in which we saw a high debt, high borrowings against which the company had to pay high interest cost, which then reduces the profit. Therefore, we get a low NPM value. Balkrishna Industries NPM was the highest for both recent year as well as a preceding year, 14.9% in the recent year of 2019 and 16.6% in 2018. So only Balkrishna Industry has managed to give good ratios in terms of OPM and NPM. As I mentioned, OPM should be more than 15% and NPM can be above 10%. Next, let us look at the liquidity ratio, current ratio and quick ratio. These ratios help us understand how liquid the company is, in the sense that how fast can it pay off its current liabilities or liabilities that it has to pay within this year using current assets, that is those assets through which it can get that money quickly to pay off those current liabilities. And the ratio for current ratio as well as quick ratio should be above 1 or at least 1 times. MRF had almost all of these companies are at a decent more than 1 times of current ratio. That is, they can very easily pay off their current liabilities using current assets. But when we look at the quick ratio, that is how fast they can convert or pay off the current liabilities using quick assets or assets that can be quickly converted into cash, these companies are lagging. MRF cannot pay off its current liabilities using the quick assets. Its quick assets are not enough to pay off the current liabilities. Even Apollo Tyre, CEAT don't have enough quick assets to clear off their current liabilities. These are just liquidity ratio that helps us understand what is the liquid position of the company. JK Tyres and Balkrishna were comfortable at 1.1 times even in quick ratio. So they have enough assets to pay off the liabilities or they have quick assets to pay off the current liabilities. Next, let us look at the total accumulated depreciation against the gross block. Gross block is basically assets of the company at their acquisition cost. So these assets or value of these assets have not been depreciated, and we also have the total depreciation up till date. And let us understand how much of the total assets have been depreciated till date. MRF's total assets at the acquisition cost was 9,373. This is the asset that the company has till now at its cost price. Of that, 2,605 has been written off as depreciation till date. That is 28% has been written off, or now only 28% has to be written off, and the balance has been written out of 9373. Only 2605 is remained. Out of the 9373, the total depreciation accumulated is 2605, and the balance of this too is still to be depreciated. That is, only 28% has been depreciated, and balance still needs to be transferred to the P&L as an expense over the future years. So here I'd want the accumulated depreciation to be as high as possible, which would then suggest that most of the assets have been already depreciated over the past years, and now very less assets or whatever balance is there needs to be depreciated in the future years. So there won't be too much of depreciation expenses going to P&L if the accumulated depreciation is high. Apollo Tyres assets or assets at their acquisition cost was the highest at 19,000. Of that, 7,513 was already depreciated. That is 39% was depreciated, which is again the highest in the group. So only 61% is left over for depreciation. CEAT accumulated depreciation was the lowest at 16%. So a lot of assets still needs to be depreciated over the future years. JK Tyre had the second highest accumulated depreciation of 33%. And Balkrishna Industries depreciation is also good at 31%, total accumulated depreciation, that is. So here I want the accumulated depreciation percentage to be as high as possible. Now let us look at the net block, that is, after depreciating the gross block, we get the net block, and on that net block, what was the depreciation rate charged? For MRF, the final assets after depreciation was 6,768 CR, and on that the company has depreciated this year 806 crore to the P&L account. That is 12%. This is the depreciation rate charged every year by the company. At least in 2019, this was the rate charged. And other companies are also at a very low depreciation rate of 7, 6 and 5% for Apollo, CEAT and JK Tyres. Balkrishna is also depreciating its assets at 12%. So these are good rates of depreciation. Apollo, CEAT and JK are depreciating at a very low rate. So that basically indicates some kind of a red flag. Not specifically a red flag, but a kind of a low depreciation rate. Here I want the depreciation rate to be as high as possible so that there is no manipulation going on in the P&L account, because companies can increase or decrease the profit by changing the depreciation charged to the P&L. If the company increases the depreciation rate at a very high pace, then it can reduce the profit. But if it charges very low, like JK Tyres depreciating the assets at 5%, then that would suggest that they are inflating the profit. When the depreciation expenses go to the P&L at a low value, then that automatically increases the profit. Okay, this ends my analysis of these companies. Next, we'll look at the table of these companies. I'll value them, give them a score and color code them, and then we'll finally analyze how well these companies have done against each other in terms of all ratios. In this video, I have used a negative marking system whereby if a particular ratio is not matching to my benchmark, then I have given it a negative score, and the score ranges from -5 to +5. I have already color coded and entered all the scores for all the companies. After giving all the scores, Balkrishna Industries has got the highest point of 180, followed by CEAT at 116. MRF and Apollo Tyres are close by at 97 points and 91 points. So the higher the score, the better the company for all the ratios taken together. Now let us quickly go through all the ratios and see the best company with the best ratios and the company with poor ratios. In terms of face value, CEAT and MRF had no split in their face value, and Apollo Tyres had a split up till 1, that is each share's face value was 1, and JK Tyres face value was 2. The lowest fall was seen in MRF at 33%, and the highest fall was seen in Balkrishna Industries at 52%. In terms of earnings yield and price to earnings, the best company was JK Tyres, available at a very low multiple of 10.1 times, of 8.8 times, and an yield of 10.1%, whereas MRF had the lowest yield of 4.8 and highest price to earnings of 23.6 times. In terms of 5 years price earning and 3 years price earnings, Apollo Tyres was available at the lowest multiple, and both Balkrishna was the most expensive at 18.1 times for 5 years price earning historical and 21 times for 3 years historical price earning. In terms of price to operating cash flow, the most expensive was Balkrishna, available at 16 times its cash earnings, and JK Tyres was available at 2.2 times its cash earnings, the best in the group company. In terms of free cash also, JK Tyres was available at 3.2 times its free cash flow, and CEAT had a negative 6 times ratio of -6 when compared with free cash flow. In terms of price to book value, the highest multiple between price and book value was seen for Balkrishna at 2.9, and the lowest multiple was seen for JK Tyre at a discount of 0.8 to its book value. In terms of price to sales, the best available ratio was for JK Tyres. So these are all valuation metrics. So JK Tyres has scored the best in terms of valuation metrics, and Balkrishna was expensive at 2.6. Valuation, a low valuation or best valuation does not necessarily mean that the stock or the scrip is the best available, or we also need to look at the other ratios together with the valuation. In terms of profit growth of both 5 and 3 years, PEG of both 5 and 3 years, sales growth for both 5 and 3 years, RoE for 5 years, and recent RoE, all the ratios for Balkrishna were the best available. And for profit growth rate, Apollo Tyres saw the highest fall in its profit for both 5 and 3 years. Even PEGs were the worst for Apollo Tyres at -3.5 and -1.8. In terms of sales or drop in sales, MRF saw the highest fall in its sales. In fact, in last 5 years, it was growing at the lowest. It had the lowest growth rate in sales and the highest fall in the last 3 years. RoE and RoE of last 5 years on average was seen poor for Apollo Tyres. It was earning a return on equity of just 13.3% over a period of last 5 years. Even in the recent RoE, it is just 8.4%. In terms of return on equity growth rate over a period of 5 years, the highest fall was seen for JK Tyres at 20% from where it was 5 years back, and the lowest fall was seen for Balkrishna Industries at minus 10% from 5 years back. In terms of return on capital employed, the highest capital employed and the return generated on it was for MRF. Even for the recent RoCE also, MRF has done the best. In terms of return on asset, MRF has done the best. For both asset turnover as well as ROIC or return on invested capital, MRF has done the best. Apollo Tyres has scored very poor in terms of ROE, RoCE, ROA, asset turnover and ROIC. All poor scores for Apollo Tyres. Even JK Tyres has performed poorly. In terms of cash conversion of profit, JK Tyres has converted the best, highest cash received against the profit, and the lowest cash received against the profit was for Balkrishna Industries. In terms of free cash flow also, the lowest free cash flow was seen for Apollo Tyres, and the maximum free cash flow still left with the company was for Balkrishna at 42%. That is, only 42% was used up and the balance was left over as free cash flow. In terms of profit over its 5 years average, the highest growth in profit was seen for Balkrishna Industries, and the lowest, in fact, for CEAT, the profit fell below. From MRF, the profit fell by 30% below its 5 years average. In terms of growth over its previous year, highest growth was seen for Apollo Tyres at 15%, and the lowest, in fact, a fall over its previous year was seen for MRF at 11% fall from 2018. In terms of annual conversion of profit into cash, the highest conversion was seen for JK Tyres at 299% above its earnings, and the lowest conversion was for Balkrishna at just 9.9% of its earnings. Quarterly sales growth and quarterly profit growth rate was seen highest for Balkrishna Industry, and the lowest or the worst performing in the quarterly analysis was MRF, receiving or getting a fall. Even JK Tyres' profit has fallen by 76%, highest profit fall. And in terms of growth in sales, the lowest sales was seen for Apollo Tyres year on year. In terms of net worth, JK Tyres is the smallest company and MRF is the largest of the group companies. The highest contingent liability was seen for Balkrishna at 22% of its net worth, and the lowest contingent liability was for Apollo Tyres at just 1.7% of its net worth. In terms of debt to equity, the highest debt to equity was for JK Tyres at 2.5 times, which is a very high ratio. Balkrishna had the lowest debt to equity ratio along with MRF. Interest coverage was seen highest for Balkrishna and MRF. Both CEAT had a above 4 times interest coverage, but JK Tyres saw a below 4 times interest coverage. That is, EBIT was just 1.6 times its interest cost. The highest borrowings against the profit was for JK Tyres. That is, its borrowings were 32 times more than the latest year's profit. The best performing for debt to profit was Balkrishna, whose borrowings were just 1.1 times this year's profit. So it can very easily pay off its profits using, its borrowings using the current year's profit. The highest promoter holding was for Balkrishna, and the lowest promoter holding was for MRF. The highest pledge was seen for JK Tyres at 35%, followed by Apollo at 15%. The other three companies have not pledged any of their shares. In terms of debtors to sales, the lowest debtors to be or payment to be collected from debtors against the latest year's sales was for Apollo Tyres, and the highest collection was for JK Tyres at 18.8% of the sales. In terms of how fast the company is collecting payment from the debtors, the fastest collection was seen by Apollo Tyres within 24 days, and the lowest or the most days given to customers to pay was by JK Tyres at 68. 3 years back also, JK Tyres was taking 74 days, the highest, and Apollo Tyres was taking the least amount of days to collect payment from the customers. In terms of converting inventory to sales, the highest conversion was done by Balkrishna at 8 times, and the lowest conversion was for Apollo Tyres. 5 years OPM was the lowest for Apollo at 13.6%, whereas along with for Balkrishna Industries it was the highest at 25%. Net profit margin was highest for both for this year as well as its preceding year. Current ratio, quick ratio, all were best for Balkrishna. CEAT seems to have done poor in terms of all the other companies. In terms of return ratios have done poorly. In terms of accumulated depreciation, highest accumulated depreciation was seen for Apollo at 39% of its gross block, and the lowest depreciation was for CEAT, accumulated depreciation, and the depreciation rate charged on the net block was seen highest for Balkrishna at 11%, and the lowest depreciation charged was by JK Tyres at just 5.1% on the net block. The highest dividend paid was by Apollo Tyres and JK on the current price at 2.1%, and the lowest dividend yield was given by MRF at 0.1% of the current price. So this concludes the individual ratio analysis. Now we'll quickly move on to the metrics which I've grouped, all the ratios which I've grouped into different metrics like efficiency, cash flow, growth, solvency, return, and valuation metrics. These are the ratios that I've covered under the efficiency metric. These are the ratios which are under cash flow metrics. These ratios are covered under the growth metrics. Solvency covers promoter shareholding and other ratios. Return metrics are the profits that the company has generated on different variables. And valuation metrics are price compared with different variables. I've given weightage to each of these metrics. Efficiency has got a weightage of 6, cash flow 5, and so on. Valuation metric has got the least weightage of 1 point. So the higher the weightage, the more importance that metric is, and those ratios are. After putting in all the ratios, all the scores, the scoring hasn't changed for any of these companies, except that Balkrishna has done the best in terms of efficiency. JK Tyres cash flow was the best. In terms of growth metrics, solvency, and return metrics, Balkrishna seems to have done the best. And valuation wise, CEAT was available at the lowest valuations. JK Tyre has performed poorly in efficiency metric, growth metric, and return metrics. Apollo Tyres has performed poorly in cash flow metrics. MRF has performed poorly in solvency metric and valuation metric. It is highly valued stock, so we still have to wait for it to come down price wise. So this concludes my analysis. As I've already said, The first rank goes to Balkrishna, second goes to CEAT at 389 points, MRF comes third at 334 points, and Apollo Tyre comes fourth at 312 points. JK Tyre has got the lowest score of 219 points and comes fifth. Thank you for watching this video.